Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Brooke Thackeray. He's at Horizons ETF Management Canada to talk about the uranium sector and some opportunities you see there. As we just told viewers, during August, the uranium stocks did well, and they are part, we have to remind ourselves sometimes, they are a big part of the energy index on the S&P TSX Composite. It's not just oil and gas producers, the uranium producers are there as well.
Yeah, so uranium has been doing extremely well, and that's because you're seeing more and more countries making announcements around using nuclear energy. And there's a resistance for this for a long time, but now we're starting to see that really increase, and it's getting a lot of headlines, which is really helping to push up the price of uranium. And so we're seeing that slowly rise. But there's also a seasonal factor as well. And this is the graph of uranium right now. And you can see here, this is just on a monthly basis from the Federal Reserve. So it's a little bit different than the spot price, but it shows you the overall trend. And you can see 2011, that was Fukushima in Japan, where you had the nuclear accident. But also, if we go back further, and we go back to the early 2000s there, and you can see the spike that took place in 2007. That was a huge spike. It shows you the potential that can happen. And we've sort of forgotten all that, but we had some floods in mines back then. We had some restrictions, and commodities were doing really well. And even last week we saw Chemical talk about its reduced production starting to take place. So there's some potential there. Also, from a seasonal basis, if you're looking for a catalyst that usually triggers uranium to do well, although it's done well here now, is the World Nuclear Association has their conference this week. And the uranium and uranium stocks tend to do well after that.
Interesting.
Because that's when they basically talk about all the trends that are taking place in the market. There's a lot of excitement that goes into that.
And I think that's important because the uranium market is a more difficult market to track, I think, than is the oil market, which is so liquid, and you get data every day on the price of oil. The uranium market is very much different. It's less liquid and a little bit mysterious, I think, to outsiders.
Yeah, because here you have the demand can just all of a sudden come at once, or not really change very much, and the supply as well can be online at one flat level. So it's very, very different as far as that goes, as far as the liquidity goes. But we are in a spot right now where we've seen uranium perform well, and it's not. That was a graph of uranium, but that's uranium stocks or uranium ETFs also tend to benefit at this time.
We could take a look at some of those. Cameco, of course, is the big one. CCO on the TSX, the biggest uranium producer in the world. It's done well so far this year. Denison Mines is a smaller name that gets a lot of interest at times in Canada. There's Cameco, year-to-date performance, better than 65%, strong upward trend since the spring of this year. Denison is coming next. There's Denison, it's up 24% so far this year. And there's a Horizons, I believe there's a Horizons uranium ETF that we are going to take a look at as well. There's the ticker symbol HURA. That one is up nearly 30% so far this year.
Well, this is the benefiting from all the news that we've seen and the rising uranium price on that. So for full disclosure, I do work for Horizons on that. That's an ETF that holds a number of stocks and also a little bit of the Sprott physical product as well in there. But we're just seeing the stocks benefit. So it's not just the uranium pound price that's been going up, but there's been a lot of excitement that's going on to that with companies being able to take advantage of the situation. And we just see this flood of announcements coming in, country after country, saying, okay, we're going back to using nuclear power. We're increasing our nuclear power. Even Ontario, look what's happening in Ontario. It'll be quite a few years before all this takes place, but this will all benefit.
And it's quite a few years in all these countries that make these announcements because it takes a long time to build a nuclear facility. But there is a lot of talk as well about small modular nuclear reactors, correct? And they are, as the name implies, they are much smaller than the typical reactor.
Yeah, so SMR, small modular reactors, are a different type of solution. Instead of having a big, huge Bruce nuclear facility or Pickering, it's a much smaller facility. And those can be brought online quicker. They're not the same build that's taken place, and you can put them in different places as well. So there's some applications. So that's really a new use for nuclear. So nuclear overall, but you can use it in places where you couldn't use the big application before. So that should also help drive demand over time. And as I said as well, those products can come online a little bit faster once they really get going.
Brooke, it's been great to have you back. Thanks a lot.
Oh, thank you very much.
That's Brooke Thackeray. He was our featured guest of the morning. He's also a research analyst at Horizons ETF Management Canada.
All right, we are back. If you're just joining us, the Bank of Canada maintaining its interest rate decision at 5%, but signaling that the war against inflation has not been won, and there is a chance they could raise rates yet again. That's a point that we have been debating, mostly in a polite way, on the panel. We've got Ed Devlin, Jim Thorne, and Earl Davis. We talk about what it means for the market, how you're invested, and we will get back to that. But for another part of the population, they are looking at what does this mean for the housing market. I mean, the housing market has been resilient, maybe dented, but still resilient in the face of this. How do you think about that, Ed?
You know, I don't have a strong view of that. Remember I said it, we did some research on the household formation, and again, a lot of noise happened with the pandemic, and now we've let in like 1 million people. So the data I was looking at before kind of said we haven't overbuilt. And so then it just becomes a price issue. And the price issue is really a function of rates, right? So we saw skyrocketing prices. So I don't really have a strong, if someone has a view the market's going to collapse, you know, maybe, you know, I really don't have a strong, this market has perplexed me, let's put it that way. I would have thought it would have gone down more, but I think it's the increase in bodies in terms of immigration that's keeping it up.
Well, this is where, Jim, you're out of consensus view. You don't work for a bank that sells some of these mortgages. So you could give us a straight talk on what do you think is going to happen with the housing market, given all the little inputs?
Well, I agree with previous comments that this isn't 2008 in terms of it's not identical to the United States. So you're not going to get a subprime crisis. The labor market is not as mobile in Canada as it is in the United States. So if we take the late 1980, early 90 playbook up here with when John Crow bombed the real estate market, what we should get is we should get real estate prices after they find a level go sideways for a decade.
And Canadians are not used to that.
Yeah. Well, but real estate is not an investment tool. I mean, real estate should be growing.
It is for many people. It is for many people,
right? And that's where I go back and I agree with Dodge, who is basically, let's get the rates down to 3%, and then let's just wash out. And if you've got a house and a mortgage that you can't finance with 3% overnight rates, then you shouldn't have bought that house. But I'm much more into this.
Most of them are stress tested. They wouldn't be allowed to buy that house.
I understand, but we've got it. But to sit there, I take my view is that with the immigration, right, population growth, right, you go travel the country. People are finding Toronto too expensive. You'll get picked up at an Uber, an Airbnb, or an Uber in Winnipeg or Regina. It's a new citizen picking us up. So what I'm just trying to say is, I am just the era that the Canadians, specifically the Torontonians and the people in Vancouver experienced from 2008 on, that is over. So can we get out of this without a major correction? Or remember, in the late 80s, Rosedale house prices went down 50%.
They're not building any more Rosedales.
But that argument still existed in 1989. That's the thing. So, you could get
in 1989 in Newmarket, and it did trade sideways for a decade.
But it traded sideways. That's our best case scenario. Would be trade sideways for a decade.
All right. In the 1980s, you bought it for maybe $300,000, which was a lot, and now lower.
Right.
Yeah. Newmarket. Yeah.
But that would be the best case, right? And then we go from there. And so my whole argument here is. I hear what folks say, and I just look at this completely differently and say that, I think the central bankers, and here's the other thing, I wrote an article in the Globe and Mail. Let me be blunt on this one. Bank of Canada doesn't have an independent monetary policy. Because if they did, because what you hear when you sit there and say they should drop it to 3%, what's the first thing I hear out of businessmen? What's that going to do to the Canadian dollar? Right? Mm-hmm. So the Canadian economy is not a diversified economy like the American economy. The Canadian economy does not have a growth area, which is the southern United States, which is Texas and Arizona. We don't have that. We've got housing and we've got real estate. Housing and then we've got energy, okay? And so we're going to have a significant correction here. In GDP because of this, because yes, the Fed is doing, or the Bank of Canada is doing what the Bank of Canada is doing. As an investor, as a fiduciary, I'm saying to people, get out of Canada, right? If the Fed or Bank of Canada continues to raise rates, it's only going to get worse. And I don't want to be an economist or an investor who basically says, we were surprised. We should not have been surprised about the GDP numbers because
I know. Okay,
GDI
but
had been
I'm talking housing. I'm talking housing because people who are watching want to know, okay, is it going to go up one more time? Can I buy a house? I don't think the rate actually matters so much as the certainty, right? I think if you're afraid that you're going to be priced out one more time, and we saw that the minute they paused earlier this year, it was back to the races. There is a voracious appetite to own homes in this country because we are so undersupplied. So with that rate certainty, call it 5%, even 5.25%, what happens to the housing market?
Yeah, you know what? I think it largely sidelines. I think we've seen that the significant sort of increase in house prices are past us. I think it sidelines. I think there's two components to say why it'll be supported. One is you alluded to before, people are employed, so they're able to pay the mortgages. Another thing that I say to people is like, people don't buy houses, banks buy houses. Banks have the title, you have the mortgage, right? So as long as bank earnings are good, which they are, we still see that, they're still lending, there's still mortgage availability, housing will still be all right. Coming back to the investment tool thing, it's not an investment tool, and this is how I defined it as a Jim, it's a savings tool. And the reason why I define it that way, an investment is delayed consumption. It says, I'm not going to spend this dollar now, I'm going to put it in something that will earn me more later. When you live in a house, you're consuming it. If you're buying a rental property, that's an investment.
Right.
And that's just how to discern between the two.
And people look at the stock market, that's where it should be, but they don't need stocks like the way they need housing. You can't live in a stock.
Yeah.
what happens to all these people that have 2 and 3 investment properties? What happens to all these people that bought a house because they're going to do Airbnb it and play the price appreciation game? So we have
I guess
a
you
lot
have
of
to ask how significant of a portion of that. That's a risk that they took, right? You can't manage those people unless it's half the population is doing stuff like that.
I can remember sitting with my sister's girlfriend's father in 1986 talking, he's a dentist, basically saying the easiest money to ever make is to sit there and put 200 or 20 down on a condo. You're going to take it in 3 years. The price goes up. And then you just sell it as you take hold.
So you would not do that today?
This time it's not different. That's the point. We've seen this before in Canada in the late 1980s.
Except I would say, and I thought this was going to happen in Vancouver like 10 years ago when there was all that speculation going on, and it just didn't happen. And I think, fundamentally, there's, again, it gets down to household formation. That's demand for it. So you got to build the unit. So if you build too many, there's speculative parts of the market, and there is no housing market. There's a market of housing markets, like they're all local kind of things. So I think you can have some corrections and some noise.
I just think it's all about
certainty. Are we going to have
certainty.
something that's going to affect kind of the...
It's certainty, and we are experiencing the largest intergenerational transfer of wealth, and people who can't afford it on their own are getting it from their parents, and they've got the money to spare. And that's what's going to support them.
And what I experienced when I was in the States, which was very interesting, was after 2008, because of the well-managed banks, Canadian banks, we didn't have a problem. All of a sudden, for significant, wealthy, global individuals, in buying a piece of property in Canada to have assets safe because it's a well-managed banking system was very attractive. And I was in many meetings down south, and they're asking, because I was the Canadian guy, right? Yeah. And so what I would say is that also supercharged. I mean, so when you keep saying Vancouver, well, it's China, or here it's Russian, Chinese money, Eastern European money, Indian money. I mean, this was a destination for very wealthy people that have multiple homes around the world to come to Toronto or Vancouver to basically buy a home.
Yeah, but that's the very high end of the market, right?
Very high end of the market, yes, sir.
So, I think that, again, I think it's just, I said earlier, it perplexes me. I think it still perplexes me a bit, I think. But the one thing to know about it, I like your idea, but it's a vehicle for savings. One of the best mortgage investors I ever knew is like, you don't buy a house, you buy a monthly payment. Now in the US, because they can lock it in for so long, there's more stability there. Here in Canada, we see a bit more volatility around that. But that's the way to think about it. Like, as can people still afford their monthly payment? And that's when you have to look at wage growth versus housing costs. And I think that will make its way through housing prices. But again, I don't have a strong view either way. I'd probably say down before up, but that's a guess.
Well, for more on what's happening out there on the markets, let's bring in Pierre Ouimet. He's the head investment strategist with UBS Canada. Pierre, thanks so much for making time for us today.
Pleasure being here, Jacqueline.
It's another central bank kind of week. We had the Bank of Canada yesterday making its latest interest rate decision, deciding to go with a hold. And we were just hearing from the Bank of Canada Governor Tiff Macklem about the road ahead and that progress to getting to that 2% target, which they are determined to do, to get to 2% specifically, is slowing. It sounds like it's going to be, quite the trek, Pierre.
Yeah, it's going to be a long road. I mean, it's not going to happen overnight. And the Bank of Canada has done a lot of work. And I'm not surprised they paused because it looks like the Canadian economy is pretty well dead in the water at this particular point in time. So it's, it would have been scary if they'd raised rates again, honestly. It's the Canadian consumer is a lot more sensitive to interest rates than the U.S. consumer is, particularly on the mortgage side. But we're starting to see some problems in auto loans and obviously on the mortgage side as well. The banks reported recently, and not a big fuss about higher provisions, but they're inching up. So it's kind of a slow creep towards call it a soft landing, call it a mild recession or something, but there are problems ahead. I mean, I think we're going into the fog here.
Yeah, we did see that contraction in the second quarter in the most recent GDP data. Some of that likely coming from effects from the wildfires and floods that we saw in this parts of this country as well. But Bank of Canada Governor Macklem was talking about those small contractions. If they do add up, is that a recession? I mean, maybe like you were saying, that's more of a soft landing, even if we do see two contractions, 2 quarters of contractions in a row, and it would be a technical recession, but maybe not one that Canadians would really feel in the way they may have in the past.
Well, if you look at the data, really the contraction was a result of inventories, so inventory draws and also trade. Domestic demand was actually up by 1%, but domestic demand was a lot stronger than that in the first quarter. So, and consumption did slow as well, and they did revise downwards also the first quarter numbers as well. But consumption is slowing, and that's been kind of the mainstay, not only the Canadian economy, the U.S. economy as well. So, as the consumer goes, there goes your economy. Well, basically, it's so that's something to worry about. And looks like the July numbers don't. They look pretty weak, generally speaking. But of course, it was the port strike in Vancouver. But that's actually going to be good for our trade balance, which is because our imports will be down, and that'll actually be a positive contributor to growth. But those volatile items like inventories and trade, you kind of X them out and just look at what domestic demand is doing.
So when you're thinking investment strategy, Pierre, in this sort of environment, with uncertainty hanging over the economy, and in this place where we know that central banks are going meeting by meeting, trying to figure out what the data is telling them to decide what they're going to do with interest rates, how do you navigate that?
Well, we've been defensive for a while, and we remain defensive. I mean, look at our overall strategy. We like fixed income. We've recently upgraded our equities, but you still look at the risk-reward depending on the various scenarios. The risk-reward is not that favorable for equities overall. So fixed income still looks like a good place to be, quite honestly, because if there's a major slowdown, if there's a recession, then that's clearly the place to be. Where you have to worry about on the fixed income side is what's going to happen on credit. That's another aspect of it, which is a little bit more difficult to come to grips with. But typically in a recession environment, credit does run into problems. So you have to focus on higher quality and investment grade bonds and move away from high yield and non-investment grade credit. So that's something also that could creep up in 2024. Everything's been pushed out to next year for all intents and purposes. So that's what we're focused on right now. And I think the central banks are, they're doing as much as they can really to to be cautious. But in the U.S., I think the Fed's going to have to raise rates because, contrary to Canada and the rest of the world, the U.S. is actually booming right now, which is kind of a big surprise to everyone. But there's so much fiscal stimulus going through the system with the Inflation Reduction Act and the CHIPS Act and other things of that nature. There's a lot of investment going in, and it looks like the consumer's still got some pent-up savings as well. The employment market's been relatively robust, better than in the U.S. it has been here in Canada, so incomes are kind of holding up for the time being. But all this fiscal stimulus in the U.S. is just going to hold up the U.S. economy. When that runs out, I mean, right now the U.S. is running a deficit anywhere between 6 to 8% of GDP. I mean, it's incredible. It really is incredible. And how long that can last is debatable, but I don't think it's sustainable. So if you go from, say 6% of GDP deficit to 4% or 2%, and you get a little bit more of fiscal sanity, that's actually going to be a drain on the U.S. economy and a headwind as we head into next year. So, and of course, next year is an election year. So there's a lot of things that are kind of quite uncertain right now, and but the U.S. is kind of doing their own thing right now, contrary to the rest of the world, China, Europe, even Canada. So I think it's eventually going to turn around and we're going to get weaker growth, but it's been put off for the time being.
And like you mentioned, Canadian consumers are in a different situation than the U.S. when you're thinking about those mortgages, being able to sit on a mortgage for 30 years at the same rate, and why wouldn't you do that? Pierre, thanks so much for joining us today. We have to leave it there, but thanks for your time.
Pleasure. Thank you.
That was Pierre. We met. He's head investment strategist with UBS Canada.
Well, Toronto's International Film Festival is underway. While Hollywood is navigating labor strife, TIFF also shines a spotlight on the international film market. Films from around the globe are increasingly connecting with audiences at the box office here in North America. Here's what Cineplex CEO Ellis Jacob had to say about that with us last month.
We used to do about 5% of our box office from international. For the first half of this year, we were over 10%.
Getting back to Toronto's film festival, there are more than a dozen South Asian film entries this year, and audiences increasingly, for example, leaning into Bollywood productions. Our next guest is a veteran of India's film industry. Karan Johar helped build one of the country's most successful film producers in Dharma Productions, and he's here in Toronto for the premiere of his new film, Kill. Nice to have you with us.
Thank you for having me.
And it is remarkable, really, everybody obviously has always talked about the Indian film market and the growth of the Indian film market. But at the box office in North America, you really are starting to see those numbers climb as well. Do you start to feel that every time you come back to North America, let's say, for a film festival like TIFF?
It's very exciting to be at TIFF. And we speak of North America, I think in the last decade, we've seen a huge, like an exponential advancement of our numbers. With the millions, the kind of films that have worked not just from Hindi cinema, but also cinema from Telugu and Tamil and Kannada and Malayalam, the other South languages, have gone into like 10s and 20 and, beyond that. Those numbers are incredible. So when we read those numbers for our films, we know that the reach is wide. It's gone beyond the diaspora. It's also now penetrating into international audiences as well.
Yeah, I wonder, is it just a combination? Streaming platforms too have helped invite the audiences to see a lot more at home. But also, even we were just talking about here in Canada, how we have record population growth. There's people from around the world that come to Canada, and to a certain degree, they want to bring some of that culture with them as well.
Yes, and I think there's so many there are Indians and across the world, of course, but like 1 in every 6 is the data that in the world is Indian. And in Canada, you feel so wonderful to be embraced by so many people from your country. And that's why these numbers that never ever existed, in our tabulations is happening. So I think it's like you rightfully said, the streaming has really brought the world together. We were all watching content from all across the world. I'm obsessing with K-dramas. Hopefully they'll start obsessing with us.
Yeah, well, let's talk a little bit about what you brought to TIFF this year and how it actually speaks to a little bit of an evolution in your business as well. Why don't you tell us a little bit more about it?
Well, for us at Dharma Productions and our producers at Sikya Entertainment, helmed by Guneet Manga, Guneet was one of the first Academy Award winners in our country, so we're very, very elated to collaborate with her. Kill is something like India has never seen. we've never made a film like this. It's a 1 hour, 45-minute action on non-stop. It's got so much blood that it's like, it can kind of like, either suck you in or throw you off. Like, now I normally say people make films with blood, sweat, and tears. This was made with just blood, and blood. Blood porn is what I like to call it.
Okay. And for you, as both a filmmaker, but as a business builder, what goes into that process? I guess you can be creative, both as a filmmaker, but also in how you want to build your business within a growing film industry. What do you think about? Like, what's top of mind for you as you've reached sizable heights now? What do you want to keep doing and growing with?
Well, I think for any filmmaker, our business, I would say, is a beautiful blend of commerce and art. So while you really want to make the best possible film with the best people, but you also want to make sure that the film is for the audiences. That's my belief. We run a studio back home called Dharma Productions, and our belief is that we want to make movies that reach out to wide audiences. And if you can tap into a global market with your film, then that's the icing on the cake. And that's our desire for Kill as well, because it's a genre film. That's why we're at Midnight Madness in Toronto, and we're hoping tonight for lots of Midnight Madness. It's a film that I think can not only do domestic business and really, really create a market for that kind of film, but also I think globally we can totally become a cult film. I may be speaking too soon, but that is the aspiration.
So we'll see what happens. Obviously, you have a pretty good track record on that front. And as I mentioned, because in part of the Hollywood strikes this year, it shines even more of a spotlight, I would argue, on international films and international filmmakers. But in Hollywood, some of those tensions we've seen, they're tied to issues including technology. This year in the business world, everybody's talking about artificial intelligence. How does that change the nature of production? How do you think about things like that, technology, and how that changes the business going forward?
I've always felt that the empowerment of writers is the most critical aspect of filmmaking. It's something that I believe has not happened to its optimum. Even in India, I've always felt like they've been in many ways shortchanged. So I believe the writers are the soul and the structure and the surface, the everything of a feature film, a short film, a documentary short, whatever format. The writers are the stars. And they will always be. So I'm very much with them. And I feel that you can blend technology in terms of VFX, but you bring in aspects that will dilute the importance of the writer. That's not something, as a filmmaker, I stand for. Okay.
Speaking of effects, I have to ask before you go, when you talk about records for blood in a film, where do you get this? What do you do? What goes into that process of making sure you're ready for?
Well, Kill, I have to say, the movie Kill that will be shown tonight at the Midnight Madness slot is actually organically made. There's about 10% VFX and special effects, but the rest of the 90% is really organic, true blood and gore.
Oh my goodness.
It was difficult to achieve, and the team did an incredible job to achieve that feat. But yes, we are less on VFX, high on violence that is organically portrayed.
Okay. Really appreciate the time, Karan. Good luck with the Toronto Film Festival.
Thank you for inviting me.